Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Hey, welcome back to the Financial Purpose Podcast. This is episode 59. I have a lot of notes today. We're going to talk about a topic that impacts every single person living that ever touches money, period. This is a mind over money discussion, and we're going to get into a little bit on how emotions and biases affect your financial success, your decision-making, your ability to sleep with the financial decisions that you make, all of that. We're going to talk about all of that today. And like I said, I do have a lot of notes, quite a few things to talk about with this topic here. It's a hard one to just kind of fly over. So buckle in. This is going to be a great discussion, and I really hope that you find it helpful to you, because I'm not only going to talk about some of the emotional hijacks and the biases that impact our financial decision-making, I'm also going to give you some definitions around these things and even some strategies on how to help yourself past the hijacks, or at least to recognize when they're happening so that you can know, hey, this is something that is something I need to deal with. This is something outside of the norm. This is something that everybody struggles with. Let me at least recognize what's going on. Let me try to step back and make a better decision without the hijack having all the control. So when it comes to behavioral finance, most people believe that they are making rational financial decisions, but in reality, there's always psychological factors that often cloud their judgment. And if you go back to episode, I want to say it was somewhere in the 20s, I did a podcast episode with Jamie Bourne, who is a licensed psychologist, and I ought to have Jamie back on the podcast at some point to dive a little bit more into this, especially with the work she's doing around the entrepreneurial journey and the psychology of money and life choices and that kind of thing. But we talked a lot about what's called a money script, and this is something that is always running in your mind. It's formed at a very early age. A lot of it has to do with how your parents were around money, what you experienced with money, what you saw, how they made their choices, and a lot of that just kind of gets baked into how you see money. It gets hardwired in a bit, and that money script is always running. And sometimes that money script can actually be a little bit unhealthy. Sometimes it can be very healthy depending on the situation. But those psychological factors definitely have an impact on the judgment. And behavioral finance, kind of as an overarching thing, it dives into the emotions like fear and greed and excitement, and how they influence our decisions when we're thinking about things like how we invest, how we save, how we spend money, what we do, when we do it, how we feel about it, whether we're guilty for it, happy for it, that kind of thing. I saw a thing the other day for leaders, because it was in a leadership kind of book, and it said to remember that when you're dealing with people, they are emotional creatures and not logical creatures. And so it's very hard to be logical all the time, because so much of what we do and think and say and feel and how we act is tied around emotions and feelings. And that's very challenging, especially for someone like me, who's a very logical processor. I tend to be able to see certain things from a very logical perspective, but I will tell you, and my wife will tell you also, that there are other things that I see from a very emotional perspective. So it's really interesting how that works. So here's what we're trying to do with this particular episode. I want to help you become more aware of how emotions play a role in your financial life. I'm going to provide a couple of strategies for overcoming those biases and the emotions, and help you be just a little bit more rational in that decision making. So as we get started here, why emotions influence financial decisions are because of things like fear and greed, number one. Those two emotions are perhaps the most powerful, which is why I'm talking about them first. They drive the fastest and probably the most efficiently the most irrational financial decisions. Fear causes panic. It can cause you to panic sell, especially if the market has a hiccup or if you see something in the economy that gets you a little bit excited on the fear side. You're likely to just make a real quick kind of knee-jerk decision. Greed is the flip of that, and it can cause you financially to chase higher risk investments when it appears that the market is going up, or if you're feeling good about having a good month at work, or your business is having a good year, or you're just feeling a little more financially, what we call it, footloose and fancy free. You're probably going to take more risks. And that leads to overconfidence bias as one of the biases. And many people believe in those times that they can outsmart the markets or that they have better judgment than others, even your financial advisor. Just saying. That also can lead to excessive risk taking. And that bias can be particularly dangerous when things get very speculative, where the market gets really volatile. And a great recent, and I'm going to go to recency bias next, so this is really a perfect segue, but a great recent example of overconfidence would have been in the markets of 2020, 2021, coming out of the pandemic. I'm sorry, I'm looking at my hand and I just realized I have blue marks all over it from my ink pen earlier in the days. Anyway, it was distracting me. So 2020, 2021, everybody was overconfident about things like SPACs and NFTs and crypto and the stock market and GameStop and AMC and all of those things. And then we had 2022 and it washed out a lot of that overconfidence. And where that gets challenging is that sometimes as I go into recency bias, you tend to think that the things that happened most recently are what's going to continue to drive things forward. So in recency bias, people tend to place more importance on recent events, whether positive or negative, and it can distort their expectations for the future. So as an example, in 2022, after a crash of the market, and I say crash with air quotes because the stock market, particularly the S&P 500, did go down about 24 and some change percent that year. It bottomed out in October of 2022, and even the bond market was down. I don't remember exactly how much, but it was notable to have both stocks and bonds down at the same time, and so that led people to think that another crash was going to be imminent. That every time the market would bottom and then it would start to come up, that the other shoe is about to drop. The same thing happened coming out of the great financial crisis in 2008, 2009, for all of the years. So that market bottomed in March of 2009, and all the way up until 2013, investors were waiting for the other shoe to drop. This is a dead cat bounce. It's just an extended, bear market rally. It's going to crash again and that kind of thing. And that's all recency bias. So once we understand those biases, and there's a few more that we could go into, but I'm going to cut those because those are the ones that are kind of more important when we're driving financial decisions, in my opinion. I want to explore a little bit more about the emotions and the ways that we are influenced or just outright hijacked in our financial decisions. And as I said earlier in the setup of the podcast, I'm going to define the hijack that we run into, how it infects. That's actually not a bad word, but what I mean to say is how it affects our decision making and strategies that you can use to overcome and at least recognize when that hijack is happening. Now, I want to do just a really brief disclaimer. This is very important. First of all, I am not trained in any kind of psychology or psychological studies. I've taken a couple of courses on psychology. I've read a lot about behavioral finance. It's not my training, though. So these notes have not been vetted by anyone in the mental health profession. I am not part of the mental health profession. So if you hear anything in this episode and you say, you know what, I really need help with that, or this is something that I see coming up over and over in my life and I should probably think about getting help, or I need help with this, please reach out to me. I'll be happy to get you a referral to somebody in the mental health field who can be very helpful to you to come up with personalized strategies specifically for you and where you have some struggles. And it's perfectly acceptable and okay and absolutely recommended to ask for help when and where you need it. So there's no shame in doing that. If you want help with any of these, please reach out. If you're already working with a mental health professional, take these notes or send them this episode and say, hey, specifically, I want to talk about this thing. And I hope that will be helpful to you. And I'll be, like I said, I'll be happy to get you to somebody if you don't know somebody or you're not sure who you can trust. We can do that. So, okay, let's get into these. So the very first hijack I want to talk about is loss aversion. Now, this is a concept where the pain of losing something is felt more than the pleasure of gaining something of equal value. So a great example is it's going to hurt you more if you lose $100 versus if you gain $100. So if it hurts more to lose and it doesn't feel good to gain the same amount of money, that's loss aversion. It's a disproportionate emotional reaction, and it causes people to make overly conservative decisions, or on the flip side, hold on to bad investments too long in the hopes of avoiding a loss. So a good example of this is, let's say you bought a stock. The value of that stock right after you bought it decreases by 30%. Even though the market signals that it might be a smart time to sell, or there's something that's happening in that company, or maybe there's an activist investor that is short selling, whatever it is, you hold on to the stock because you hope for a rebound, and you want to avoid the emotional pain or the realization of actually selling the stock and realizing the loss. Now, that behavior is irrational because holding on to a losing investment, you might actually miss opportunities to reallocate money into something that might be more promising or better suited or have a better outlook than what you're holding on to. Now, this has happened to me a few times in my own investment career, now with my own money. And it tends to be something very similar where you have a conviction, or I had a conviction about something, I bought it, or I saw something that I felt like I was missing out on, right? So I became victim to my own FOMO. And then it goes down from there. So candidly, a great example is every time I buy Apple stock, this is what happens. I buy the stock in the company, the stock goes down, and then it just stays down, and then I finally get annoyed with it and I sell it, and then the stock goes right back up, right? I think we all have one of those situations or one of those companies or something like that. For me, it's Apple. I don't know why. But anyway, the inability to relieve yourself of the emotional pull of, I bought something, it's not working out, I need to just keep holding on to it because it's going to eventually turn around. Sometimes it's best just to cut the losses, reinvest, and find something else that has a better direction going forward. So how loss aversion affects your decisions is, as I said, the two common errors are being overly conservative for too long, and then second, holding on to something that's not working out, or what we would call a loser, quote unquote, for too long. Now, here's a couple of ways you can overcome this particular hijack. The first is, instead of thinking about that declining investment as a loss, try to think of it as an opportunity to reposition into something that's going to have better growth. So rather than seeing it as a loss, seeing it as an opportunity to do something better, to make a better choice, to free yourself up of something that's not working and go after something that will or has a better chance to. The second thing you can do is define at what point you will sell an underperforming asset, and you need to stick to that rule regardless of the emotional urges. You can use things like stop loss orders. You can have predetermined exit points. And I'm a big fan of this. At Life Moves Wealth, we do this. It's called a buy-sell discipline. And so depending on what the investment is and why it is underperforming and what's going on and what the outlook is and how the sector around that stock or that investment is behaving, what the economic outlook is, there's a lot of factors that go into, number one, what we consider as the criteria to buy an investment, and then number two, what we consider as the criteria to sell an investment, either when it's underperforming or even sometimes it's outperforming and we want to ring the cash register. A great way to do this is to have a downside price target. And so, for example, a great example of this is had a client probably 7 years ago who was in a certain stock, and it had a big run, and it started to just kind of drop its price. I mean, the thing had gone from like, I don't know, $20 or $30. It kind of shot up to about 225 or somewhere in that range. And it started to drop kind of closer to the 200 range. There was some weird news around the stock that just didn't quite make sense to me. And so the client called and was really emotional about whether or not he should get out of that stock. And so we set a downside target, and I said, here's the thing. If it hits this downside target, that's our warning. Let's have another conversation. And if it violates that level, then let's consider selling all of it or part of it. We can kind of hold on to some of it because we still like the stock. I still like the story. I still like what's going on. And a couple of days later, the stock violated that price level to the downside. The client called me, and we decided in that conversation, because of the outlook of what the analysts were projecting, we actually decided to hold it. And the stock was only down for a couple of days, and then it went right back up. And I remember that client calling probably about 2 months later and just thanking me for the ability to have a rational conversation about something that felt very, very emotional. And it actually ended up benefiting him. And so that time it worked out, but sometimes it does make sense to say, you know what? Let's actually cut a little bit of what we're seeing here. Let's take some profit, or let's take a loss now. Let's stop the bleeding and do something else. And that is very, very important. That buy-sell discipline, I can't say enough as an investor about how important it is to know what you're buying, why you're buying it, how it fits into your portfolio, and as an exit strategy when it makes sense for you to consider doing something different. And then the last thing that you can do to overcome the loss aversion hijack is think about it kind of on a big picture. No portfolio or even a business plan will ever totally avoid loss at some point in the cycle. It's just going to happen. So success comes from overall performance. It doesn't come from avoiding every loss. There's almost no way to take no loss ever, ever, ever. Something at some point is not going to go right. Where you become successful is in seeing the opportunity to correct when something is going sideways or off the rails. And so that I have found can be very helpful when you just say, okay, big picture, what is it that we're trying to accomplish? Okay, how do we get back on track with that? And then you make those decisions. So that's loss aversion. Second one that we want to talk about as a hijack is sunk cost. And this is a fallacy that's very common. It occurs when individuals continue investing resources of time and money or effort into a project or a decision or an investment simply because they've already invested so much. Even if the current situation suggests that it's no longer a wise choice to continue that action, you just kind of keep going. So it lies in the idea that past investments should dictate future decisions when in fact only future potential really should be what dictates future decisions. And so a good example of this is, let's say you've spent thousands of dollars on a home renovation. Midway through, becomes clear that the project is well over budget. It won't add significant value to the home. You're going to have to do a whole bunch more things just to get at the original smaller renovation that you wanted to get to. And despite realizing that the project is spiraling out of control, you decide to continue to pour money into it because you've already spent that much. And in reality, it might be smarter to stop the project, reassess what you're trying to get to, and figure out how close you are to maybe reaching something that makes sense, or redirecting the investments, or redirecting the project, or something like that. This bias of the sunk cost problem or hijack, it can lead to things like wasting resources. So you throw, the whole throwing good money after bad statement. That's what this is. And also, by focusing on the past and the past investments, as your justification, you overlook better opportunities that may be more fruitful for you. So here's a couple of strategies when you're thinking about this particular hijack with the sunk cost and this fallacy here is, number one, focus on future value. When you're making decisions, consider only the future benefits or potential returns. Past investments, while they feel emotionally significant, are irrelevant when you're considering current financial decisions and you're at a point where, again, you have to consider whether or not you're throwing good money after bad. The second thing you can do is sometimes it's really hard to recognize when you're caught up in the sunk cost fallacy. Seeking the help of a financial advisor, myself included, a trusted professional, or even a mentor if you have one. And if you don't have a mentor, I recommend from time to time, have a mentor for a period of time. You don't have to have one that is forever and ever and always. You can have mentors that you can meet with for 6 months at a time or 3 months at a time, or you can do 90-day spurts, or you can do 11-week spurts or 9-week spurts, whatever. You can figure this out. But having a mentor can actually be very beneficial in taking you to the next level in your business and in your profession and in your career and where you're trying to go. And so those folks, financial advisor, another professional, a good mentor, they can help you see a situation objectively because they're not as emotionally involved in it as you are. And sometimes they can identify blind spots that you just can't see. And then the third thing you can do is before you start an investment or a project or some course of action that's going to be big, define the point at which you will reassess or exit if things don't go as planned. And this is the whole thing about in any given project, you want to have milestone dates. And the reason you do that is to check in. Are we on progress? Are we on budget? Is this thing going off the rails? Do we need to rein it in? Do we need to call a pause, a timeout? Do we need to make an exit because this is just not going to work? That can really help you prevent that emotional attachment that clouds the judgment, that creates the blind spots. And you may find it to be very, very helpful in how you make that decision by already having those mile markers or milestones or planned project dates already put into place. So that way they're on the calendar, they're going to come up, or you've set some sort of a flag throwing offense where you know when this happens, we need to throw a flag, we need to call a timeout, we need to check on this. Okay, the next hijack that comes up is herd behavior. Again, this was absolutely applicable in 2020, 21, and early 2022. Herd behavior is the tendency for individuals to mimic the actions of a larger group, often under the assumption that everyone else knows something that I don't, and so I'm driven by FOMO, or the fear of missing out. I don't want to be left behind. I don't want to be the only one who's not included. I don't want to be missing out because everybody else is benefiting. I don't want to be the one who doesn't make money because everybody else around me is making money, right? That's what happens. And in financial markets, that's how bubbles get created. And it absolutely drives irrational market movements that people who are long-term investors like myself and my clients, we sit there and we say, this isn't moving correctly. This isn't acting the right way. These stocks should not be valued this high, or these things should not be selling at this price. This should not be getting so much attention because there's no floor under it. And so we have to sit and wonder, okay, we're long-term investors, but are we the ones who are missing out? Are we the ones who aren't paying attention? And oftentimes it's not the case. So a great example is a situation where a particular stock or a cryptocurrency or an NFT or a SPAC or something like that becomes the talk of the town. Prices start to skyrocket, right? They're going to the moon, right? And there's people who drive that. So great example, Elon Musk and Doge, right? I'm not going to say that he did it, but he was certainly a part of the hype behind that particular coin, and it was just going crazy, and for no good reason other than that it was. And so despite not fully understanding the value of the asset, what underlies the asset or anything like that, people just keep investing because they don't want to miss out on potential gains. They don't want to miss out on, the Lamborghinis that everybody seemed to be able to buy, or shall I say rent, during that time period. And it eventually crashes when that bubble bursts. And that happens, and good people get hurt in the process. Great example of this is if you watch the movie Dumb Money. It's on the roaring kitty character, and who is a real person, by the way. And that whole AMC and GameStop thing that happened in early 2021, that he was part of driving that stock high, and as it came down, people lost a lot of money, and they absolutely got hurt. And people put their entire savings into it. They put their retirement savings into it, and they lost money. And so those things happen all the time. So it leads to impulsive decisions, because herd behavior encourages people to make decisions that are highly based on emotion and fear rather than logic. It leads to overinvestment in things that are overly risky compared to what they normally would invest in or consider suitable for themselves. It also leads to market volatility, as I was saying. Too many investors follow the herd. Markets experience dramatic shifts. It doesn't reflect the underlying value of the assets involved, and it does set up a big potential issue, a fall to the bottom. You can see it in the charts. Bubbles tend to be pretty easy to see in the charts. They're much, much easier to see in hindsight when you look at the charts. But there are times where you just look at these things, and I had a couple of these during that time period where clients would call me. They're like, I want it. How do I? And I'm like, I don't know. I mean, you can do it. You can open a Robinhood account. You can open a Coinbase account. You can buy these things. Please don't go crazy, because I don't see a base case for it. I don't see an investment thesis. I don't think that this is going to go anywhere. And there were quite a few of those where I was absolutely right. And there's been a couple where I was like, I'm not sure. I don't know that I like this. And it's actually worked out. So you just have to be sure that you're making those decisions well, and that you're researching them, and that you don't just follow everybody else like a lemming off the bridge, right? So here's a couple of ways that you can overcome the herd mentality. Number one is base your financial decisions on your own personal goals, financial plan, risk tolerance, and long-term objectives, rather than just reacting to market trends. I can't say this enough. When we're talking about investing, what your neighbor or your brother or your best friend or your college roommate or your water cooler buddy at work or whoever you're talking to, whatever they're investing in is 100% most of the time. So that's not quite 100%, but I'm going to say 100% because I'm confident here. It's probably irrelevant to you because it may not fit into your particular financial plan. And if it's something that you absolutely are just headstrong about and want it to fit in your financial plan, then you need to have an even better story of why you're buying it, how much you're buying, how long you intend to hold it, what you expect it to do, and when you expect to exit, and under what conditions. And that needs to match your financial plan. And there's nothing that's more important than your personalized financial objectives, because the more that you ignore those or set those aside, the more you're going to take yourself down a road that you really don't want to be down financially. Now, another thing you can do is avoid the noise. It's important to stay informed, but you have to see when things are being hyped up versus when things are appropriately priced, or they have a good future or a good outlook going forward, rather than just being what everybody's doing. The popular thing is not always the right thing, especially financially. And just because everybody is talking about an asset, again, doesn't mean it's the right or even a good investment for you. The other thing you can do, finally, is, as always, maintain a well-diversified portfolio. What that means also is very specific to your particular financial plan. You can avoid putting all of your money into a single trendy investment. It reduces your risk of significant loss. It reduces your risk of being over-concentrated in your portfolio. And that, of course, reduces your risk of being caught in market swings. So market swings are going to happen. It's going to impact anybody who's investing in anything at all. How much of that impact shows up in your portfolio really depends on how well you have yourself diversified, and again, for what reasons, and mostly how it fits into your financial plan. So again, I can't stress that enough. That's super important. Okay, so here are a couple of additional strategies that can help you manage the effects of emotional decisions, and it can help you avoid financial hijack, emotional hijack, anytime that you're looking at these things. So first, this is a great tip. Automate your finances as much as possible. So it removes the need for frequent decision making, and it's usually around things like saving. The reason why you save to a 401k with every paycheck is so that way you don't have to think about it every week. It just automatically happens. I do the same thing for other savings accounts that we have, my tax savings, my high yield savings account, which is where my most of my tax savings go. I have a trust that Melissa and I have, her IRA contributions, her 401k contributions, my SEP IRA contributions. All of those things are automated. They're on a schedule, right? Everything, the car payment, the most of our bills that come out, it's all automated, so I don't have to think about it. It just comes out. The only thing I have to think about is making sure that there's money in the account every week, because I know how much is going to have to come out in the auto pays. And so the more you can automate that, the better. When those things are automatic, you're less likely to panic sell. You're less likely to pause contributions or skip them entirely. Even when the market's not behaving properly, having those automated still goes in. Those automatic transfers into investment accounts are ideal, because when the market is misbehaving, that's a great time to buy because everything's on sale. And so if you have a list of investments that you want to add to, or that you'd like to add to your portfolio, again, under the right reasons that match your financial plan, that are suitable for you based on your risk tolerance and your time horizon, or how long you plan to invest, what it is that you expect or need that investment to do, and what your exit strategy is on either side, downside or upside. We call that dollar cost averaging, right? You continue to buy regardless of whether the market's going up or down, and it gives you a better cost basis over time, so it increases your profit. You want to be buying when the market goes down. When people get very afraid of the market is when there's a correction, and then they hold back, they pause, they don't want to make any more investments because they say, why should I keep putting money into something that's losing money? Because it's on sale. You would buy your favorite coat, purse, suit, car, whatever it is that you want to buy. You're going to wait for it to go on sale, and you're going to happily run down and buy it because it's going to cost you less. Why is it that we don't think about our investments in the same way? It's exactly the same thing. So having those automatic transfers allows you to dollar cost average easier without the emotion of deciding whether or not you should, because this, that, or the other thing, or you heard this on the news, or somebody said the market's about to crash, or whatever in the world. On that note, another strategy you can use is to find a good financial planner who can help. And so again, this is self-serving, but it's true. A good financial planner can provide objective, unemotional perspective on your finances. We're able to calculate things for you. We can show you things that you may not know, or we can correct some information that maybe is not quite solid, that you probably heard or picked up from somewhere. Usually that's around things like rules for IRA and 401k contributions, distributions, required minimum distributions if you're at the RMD age, which is currently, that's now 73, moving toward, I believe, age 75 is kind of the target. We'll see what happens. But and a lot of times it's around taxes and estate planning and setting up shell companies in other states and in islands or whatever to avoid this tax and move the money there and all that stuff. We can help you understand how all of that fits into your financial plan or doesn't. And we can help you stick to those long-term plans because we can help you put accountability in place where it may be harder for you to do it yourself. And the best way to implement that is to find somebody who you can align with, who shares the same values. My preferences personally are that you work with a certified financial planner who is fee only. And again, I'm not against anybody's compensation model because they're all over the place. I'm just saying when you work with somebody who's fee only, there's a lot less likelihood that you're going to have conflicts of interest with how you use your money and how that impacts how the advisor is compensated. So I like to remove all of that, those awkward conversations, remove all of the conflict, remove that thing where you feel like you're always being sold to every time you meet with that person. Just get that out of the way. Fee only means that we can't have any commissions or any sales things that drive payments over time or anything like that. It's just very straightforward. It's a fee for service. It's a fee for investing. It's usually flat. It's just based on this. And that's really, in my opinion, the better way to go. It just is an easier way to work with somebody who actually, by removing those conflicts of interest, can actually serve truly in a fiduciary capacity. And when it comes to financial choices, I can't think of anything more important than having an advisor who truly is working toward your best interest above their own financial interest. And that's exactly why a CFP, because we're required, first, that's the very first duty that we owe you, is the duty of loyalty, which is the fiduciary standard. And then having somebody who's fee only, so that way there's no financial conflicts of interest there. Okay. Another thing you can do is, again, focus on long-term goals. This is where working with automating and working with a financial planner really helps you stick to long-term objectives, because when you're not worried about the little day-to-day price movements of the stock market or these little weekly decisions about should I put money into my thing this week or should I do this or all of that, you can avoid being swayed by those short-term emotions and short-term decisions because they do turn into setbacks over time, because it becomes easier to not do those things. And what's easy not to do really oftentimes isn't in your best interest, whether it's financially, mentally, your fitness, health, food choices, right? All of those things, how you take care of yourself and your family. What's easy not to do gets missed, and it's usually not good for you. So another good way to kind of keep accountability to this is to regularly revisit your financial goals, your retirement goals, when you plan to buy a house, when you plan to make certain financial decisions, how you're going to fund education for yourself or your children. And the problem with those things is that when emotions run high, you have to stop and remind yourself why you're making those decisions or investing a certain way in the first place. At Life Moves Wealth, we do this through the lens of writing a statement of financial purpose. And that helps us make sure that the decisions we're making are aligned with what we say is really the most important thing about how we use our money, and that it's in the right order of priority. And when there's a decision or an emotional hijack or something that comes up, we're going to be able to spot it pretty quickly, because it's not going to quite fit into what you say is most important. And that statement of financial purpose, go back to episode 4. I do a really deep dive into how that works, how we write it, why we write it, how we use it, all of that. Episode 4 of the Financial Purpose Podcast is all around that statement of financial purpose. And it's been really, really helpful for clients. I've been using it now for probably about 4 years as a practice, and we're able to just say, I get it. This is something you want to do. Help me just see where it aligns. Do we need to rewrite this? Do we need to change a priority structure somewhere? Is this emotional hijack? Is this a midlife crisis? Is this, something that you're really concerned about? And oftentimes, by stopping and saying, hey, I get it. Let's look at your financial purpose. Let's see what you said is most important. Let's make sure we're still on track with that. Oftentimes, there's something that is underlying that decision that the client really just needs to talk through. And a lot of times we don't end up going down the path of what they originally wanted to do. Instead, we're able to get a better evaluation on things. It's not just a matter of, hey, can you afford this? Let's talk about, the dollars and cents of this decision. The very first thing we talk about is what's going on around this decision. How do you feel about it? How does your spouse feel about it? How will it impact your financial plan or this other goal over here that we set a couple months ago that you said was more important, or this thing that you've been working on for a couple of years that is highly important to your long-term success or the success of your business or your ability to hire a new employee or to put money into your retirement savings account or to buy the new house or any of these things, right? You're saving for that big European vacation because your anniversary is coming up, something like that. If there's a decision that takes you off course from that, we probably ought to talk about what's behind that decision and not just what it's going to cost in terms of dollars and cents. So the other thing you can do, and this becomes really important, especially when things are going really far sideways, is to be aware. And sometimes a little bit of mindfulness, intentionally practicing mindfulness, can help you be fully aware when you're making decisions that are out of touch with what is really important for you financially. Maybe that doesn't align with what you truly value about money. And being aware of these triggers and where you have emotional short-sightedness, pausing before you make those decisions, it can create space for logic and reflection, and it can save you from doing something, making what feels like a short-term decision that actually might have a longer-term impact. It can save you from doing something like that to hijack yourself and hijack your progress. So practicing mindfulness techniques, meditation, journaling about these things is very important. These can be great stress relievers. They can give you clarity. Sometimes if you have something that helps you have a clear head when you do it, for some people it's very physical. For me, it's physical activity. It is something like hitting a heavy bag or playing my drums or getting on my bike for an hour or two. For me, that is those are the best ways to clear my head. I don't do as well sitting in a meditation or taking a walk through nature or deep breathing exercises. All of those things are healthy, but you want to find what works for you, because that's the only time that you'll be able to actually have some clarity where you can then reflect on what's going on around you and the decision you're about to make, so that you can save yourself a lot of heartache and headache and financial missteps along the way. I have a good friend who is a mindfulness coach. He is actually a meditation coach, and people who can connect to themselves through meditation love his work. If you'd like a referral to him, please send an email to info@lifemoveswealth.com, and in the subject line put meditation coach. I'll know exactly what you're talking about, and I will be happy to refer you to, his name's Richard Dewey. He's great at what he does, and certainly if you're a meditation type person, he's your guy. He can really be helpful, and he does a lot of his coaching on Zoom. So if you live outside of the Phoenix area, no problem, he can work with you. So again, shameless plug for Richard, but send an email, info@lifemoveswealth.com, and in the subject line, meditation coach. I'll be happy to give you an introduction. If you're one of those person who just needs a good physical outlet like me, hit me up. Let's go for a bike ride, or let's jam out, or let's go punch some things around. Whatever it is, find what works for you, and by all means, that can help you be aware of what's going on, slow down that emotional hijack process. So, in conclusion, just kind of as a main takeaway, what I wanted you to get out of this is that our emotional hijacks, the biases, it's a natural part of being human, but when it's left unchecked and when you're not recognizing what's happening, it can really, really harm your financial progress. It can pull you way offline, and it takes longer to get you back to where you're trying to go. So by becoming aware of these emotional influences and implementing the strategies that we discussed in the episode, it's going to help you just make a little bit more rational progress, make some informed decisions, slow down the cycle a little bit so you can see what's going on around you, right? It's kind of like when you're driving down an open freeway at 100 miles an hour, things come much, much faster and your reaction time gets significantly slower than if you're going even, 70 or 75 miles an hour. So same thing applies here. The faster you're going, the more emotional things are going to get, the harder it's going to be for you to make a good decision in a good amount of time. Slow that down a little bit. So what I would like to challenge you to do is to take some time as you're listening to this episode and reflecting on it. Think about how you make your financial and your investment decisions. Identify any of these biases or emotional hijacks that tend to influence you, especially if it's something that kind of shows up over and over again. For a lot of people, when the market's going up, it's FOMO. They don't want to miss out on gains. And when the market's going down, they don't want to be the last one holding the bag, right? So think about things like that. Start deploying the strategies that I discussed today to give you a little bit more control over those things. And as I said earlier, if you need the help of a financial professional, if you don't have someone that you're working with, or if the person that you are working with does not ever talk about this, please let me know. I'm happy to give you a second opinion, put a second set of eyes on your strategy, put a second set of eyes on your financial plan. And if you don't have a financial plan, we can create one for you and help you stay accountable and meet with you regularly. So that way, you know that you're on track. You know that you have somebody who you can bounce these things off anytime that they come up. And you know that you have somebody who isn't just trying to sell you things so they can keep lining their pockets. Happy to help. Send an email to info@lifemoveswealth.com and put financial plan, and I'll know what that means, and we'll get that. If you need further help, by all means, reach out to a counseling professional. There's a lot of therapies that are available for you, and they can be very, very helpful. So, at Life Moves Wealth, our process is built around all of this. It's very heavily centered around behavioral finance. It's designed to not only help you understand your financial life, but also to understand how you behave around money in ways that it either hurts or helps your long-term financial success, and then more importantly, give you some guardrails to help you stay in place, help you write your statement of financial purpose so that we always have something to test. It's just a natural part of what we do, is how I believe that financial planning should be done, and when it's done this way, it's done the right way. And that's what it's all about. If you can make a good financial choice today, you're going to like your financial outcomes down the road. So that's the episode today. Again, please feel free to like, subscribe, share this, get this to somebody else around you who you think can benefit from this. Re-listen to it. I hope that it's been very helpful to you. Reach out again to info@lifemoveswealth.com. You can find us on all the social medias. Connect. I'd love to talk with you. And until the next episode, go be financially awesome. Avoid these hijacks. Take care of yourself. See ya. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.